Welcome. I'm Catherine Magana here with Steve Wolf, Rachel Ivanovich, and Vince Stefano, where we're here to provide you insights about the markets, financial planning, and tax planning. Today is June 26th, and it's been quite a couple weeks. Last week we didn't tape, but here we are. And over the weekend, the U.S.
We actually had some bombshell headlines.
We did. It was like, oh man, over the weekend, the U.S. military striked 3 of Iran's nuclear sites, and it was interesting because I wasn't sure how the markets were really going to react. And this week, the markets are actually up, and over the last few weeks, we're still looking at positive returns in most of the areas in the market except for the Russell 2000. So, here we are, and the other big headline is, with interest rates and what's happening.
And we still don't have a tax bill.
Yeah, and that too. It's like, I just saw that the SALT that we talked about in the past, where we were thinking, potentially it might be 40,000, is still going to stay potentially 10,000, which is where
we don't know until we know.
Right, and explain the SALT real quick.
The SALT is the state and local tax, SALT, deduction if you itemize your deductions. And
which helps those people that have highly appreciated homes.
Correct, exactly. So we'll see what happens. If you itemize your deductions, things may change. They may not change, but we'll know once we have a tax act.
Yeah. And then it looks like mortgage rates right now are at about 6.81% as of today. So they've come down a little bit over the last few months. And it looks like home sales have dropped by over 13% as well. So there's definitely a little bit of change going on here. And then the big thing that I've kind of been looking at is the price of gold has gone up pretty significantly this year. It's up year to date over 25% this year. So that was...
It actually came down a little bit once the bombs had hit, and there's been hopefully a peace resolution. It's pulled back a little bit. So, gold has been... I've never understood this, to be honest with you, because, are you going to pay somebody in gold? I don't know. Maybe you will.
But if you're going to pay them in Bitcoin, you might as well pay them in gold.
I suppose so.
I've never been a gold bug, but gold has done well this year. And again, I think it's kind of topped out. I think it kind of ran up in front of what was going on in the Middle East and, continued problems in Russia and Ukraine. But, I think it's pretty much topped out. And I think oil is pretty much topped out as well.
Well, speaking of oil, it was down about 14% in 2 days.
Yeah, it got creamed.
I think it was up to around $75 a barrel, and it's down around $65 a barrel. So, now that at least people think that there's not going to be disruption to the oil getting it to and from places, the prices come down.
I think it will, and the administration continues to talk drill, baby, drill. They want to get oil down as much as they can, but then you've got big oil companies that keep saying profits, profits, profits. So they don't want the price per barrel getting down too much. So it's gonna be a dogfight as always between companies and the administration, but companies will figure out a way to make money. And question, you had mentioned something about the markets. Where are the markets right now? Just give us a quick recap,
just kind of an update.
Because that way I can lead right into something.
All right.
It's like, team me up.
All right. So year to date, the Dow Jones were up 1.03%, and this is as of yesterday's close of June 25th. NASDAQ was up 3.43%. The S&P 500, 3.58, and the Russell 2000, which is more small cap stocks, was down 4.21. So once again, we've seen we're still in positive territory in some areas, but not a lot of change over the last few weeks.
Do you ever wonder if small cap stocks are ever going to appreciate more than large, which would make sense because they have a longer platform on which to run?
They will once interest rates come down. And that's typically what happens with small stocks. Once the interest rates come down and they can borrow more efficiently, you will see small stocks do well.
Well, except that interest rates were almost at zero and large cap stocks did better than small cap stocks.
But there was a period, I think, when they were cutting rates when small caps did pretty well. But again, I like small stocks, but I think right now, when you look around, the economy is looking good. You've got a stable job market. Tariffs, there's still an uncertainty, but a lot of uncertainty. But the Feds, you've got a number of Fed governors saying that tariffs may not lead to the inflation that people are talking about. So that's kind of interesting. You mentioned Iran-Israeli crisis. That's kind of coming to, and it's not coming to a close, but it's looking better than it has in the past few years. Interest rates have declined on their own without the Fed cutting interest rates, and that big, beautiful bill is still being negotiated.
Apparently, no one can go on a vacation unless they pass
That's
it.
good.
So that's
Hey,
gonna
don't go on
pass.
vacation.
Let's pass it.
I say don't pay them.
So yeah, that'll
And
get
then
them going.
the president, it's no secret, he wants Fed rates lowered, and he's definitely making a point that he wants this done. And I was looking at kind of the probability of a rate cut. It looks like in July it's approximately 25% probability, and then in September it's about 90% or higher.
90%?
90.
Yeah.
So once again, I think the market priced in a couple rate
I
cuts
think it did,
already.
yeah.
Yeah, but from a macro look, more of the economy is slowing.
Yeah.
Okay, and right now labor markets are kind of, I guess they're kind of stabilized. The unemployment rate is about 4.2%. At least that's the official figure. I think it's higher than that, but the way the government counts it, they want to make it look better than it is. Inflation is easing a little bit. We don't know what's going to happen with tariffs, but the economy, GDP, is actually slowing down. So, does Trump have an argument saying that rates should be down? Yes, there's an argument there. The other side of the argument is tariffs, and is that going to cause inflation? And the way Powell has always done things, and I think the ones before them, is let's wait and see what happens.
I think he's just a little slow. So I think everyone's feeling that Jerome Powell is is it more political or is it financial? I think he's just being very slow about making any changes.
Well, and I also wish Trump would lay off him because
Let him do his job.
let him do his job, and you can't continually downgrade somebody and expect them to cooperate with you. They're going to fight back. So let them be independent because that's what they are supposed to be.
Well, if you think the economy is going to slow, and I'll tell all investors out there, if you think it's going to slow for any number of reasons, what you have to do is you have to move your portfolio to growth stocks because growth stocks are going to do well. And now, over the past couple of months, what has happened? The market went down considerably and everybody was pulling their hair out because technology stocks were going down. And all of a sudden, technology stocks started to rally. And it brought this market from the depths of despair. Now it's hitting all-time highs. So what do I think is going to happen? Well, I think these companies, especially these big tech companies, and some of the smaller tech companies or smaller cap companies you were talking about, they're going to continue to develop AI. And these companies are doing one thing differently now than over the past couple of years. They're figuring out how to monetize AI. And that is huge because now it's causing revenue and earnings to increase, free cash flow to improve, and margins to increase. But more importantly, you're starting to see some early M&A activity where these companies—
Mergers and acquisitions.
Yeah, mergers and acquisitions, where these companies are now doing these tuck-ins to enhance their platform. So what's going on Wall Street is you're seeing a number of analysts at these big Wall Street firms upgrading technology stocks, not for the next quarter, not for the next 2 quarters, but for 26 and 27, for everything we're talking about.
Well, I think you make a good point because the economy isn't the stock market.
Right.
Okay.
Right.
A stock is an individual thing. And right now, we have this revolution going on with AI and technology. So those stocks are going to continue to do well. But the backdrop is, how will the economy do? And yesterday I had a very interesting discussion. I will get back to what you're going to say here. But yesterday I had a very interesting discussion with a friend of mine talking about what will AI do to jobs. And his response was that it's going to kill jobs. And although we've had this discussion before, I think initially that may be true. But every time we've ever had a revolution in technology, whether it be starting with tractors or washing machines or
The
computers,
internet.
they've always spawned new areas of jobs. So my thought was that with AI happening and helping businesses figure out things, there are going to be a lot of new jobs that we don't even know about. And that was my statement to him is I said, I don't know what those jobs are going to be, but I'm pretty sure there's going to be new new things in the economy that people will get jobs. I'm sorry, go back.
No,
to what you
no,
said.
no. Absolutely. I like that. No, I think you're absolutely correct on that. And I think that, investors, especially, people that are listening to us or, clients of ours, they got to stay in the market. I mean, the big casinos open from 6:30 to 1, and it's the greatest wealth creator that you can find. And I think what you need to do is you have to go out, put together a really good portfolio of growth stocks, because technology is going to continue to innovate. But think about what's happening in other places. You talked about AI. Well, financial companies are using AI now because they want to enhance their technology platforms to accommodate Bitcoin, stablecoin, and others. Energy stocks are, the old stodgy energy names are now looking to partner with nuclear stocks because they need to enhance power to run these hyperscaler databases. So, are they going to be volatile? Yeah, but use volatility to your advantage. When these stocks go down, buy more, because over the next 2 to 3 years, I think these growth stocks are going to make so much money because they just have the innovation. And I don't know anybody who goes in the stock market not to make a lot of money. If you want to make a little bit of money, go to a CD at your local bank and then pay taxes on it and get a 1% return.
So what do you think about CDs?
CDs are fine if that's what you want. But, people don't get into the stock market to make a little bit of money.
The only thing with the stock market, and I am a firm believer in what you say, is that when you're 70 years old, when you're 80 years old, you don't necessarily have the time to wait for these things to happen. So that's why you want to have some of your money elsewhere.
But things are happening so much faster, where you used to have, the market cycles being 5-6 years. It's now 18 months to 2 years. So even if you're 70 years old and you're in the market and stocks go down, they can look at how quickly it recovered from March.
But when we're having those calls a couple months ago when the markets are down, clients get scared when the markets are down and they're living off the income and all this. They still want to know, am I in the right strategy and investment? So I would agree, some growth, but maybe it's a mix, like Steve mentioned, of maybe some value.
Yeah,
and some
if I'm younger,
investments.
absolutely. Matter of fact, if I had things to do over again, although I pretty much did it the same way, but if I had to counsel somebody who was young, and when I say young, maybe under 50, I say you don't really need bonds. Okay, you really don't. Not at that point. As long as you're working, you've got income coming in, put it into the stock market or into something that will grow at a much greater rate than a CD, of course. And I think in 20 years and 25 years, when you're 70 years old or 75, your portfolio will be better off. Okay?
But how many of your investors, even at 75 or whatever years old, come to you and they say, hey, I want to be in the market, but I don't want to make any money? Come on, everybody.
No, what they want to say is, I want to make all the upside, and I don't want any of the downside.
Exactly, that's the conversation.
I guess there you got a point there. All right.
Well, when you have the upside, you have to pay taxes. So let's
talk about taxes.
Let's talk about taxes. So this last week, I met with some clients and learned about a tax strategy that I found very, very intriguing, and it has to do with what's called the net unrealized appreciation, or NUA.
This is when you should stop and say, that's a tease. Call us and we'll tell you what it's
help you.
about.
Okay, all right. And that's the wrap for this week.
I'm sorry.
But it was really interesting because I have been doing taxes for 25 years, and I've actually never had a client utilize this strategy before, but I think it's brilliant. And so it's a little used IRS rule that can help you reduce capital gains paid on your investment gains that are held in a 401k. So let's just say that you are employed by a company and you own quite a bit of your company's stock in your 401k and you're looking to retire. So typically when you have a 401k or some other sort of retirement vehicle through your employer, that money, when you retire, it gets rolled over to a rollover IRA. And then later when you turn the what they call it, the
73 and a half.
73 and a half.
Oh, sorry, 73 now.
Yeah.
It's going to be 75 later.
The applicable age, I think it's what it's called. The applicable age, which could range depending on when you were born. You have to take a specified amount out of that account every year, or what's called a required minimum distribution, or RMD. So, but you pay ordinary tax rates on this money when you take it out, which are whatever your marginal rate is. So it could be as high as 37%, which is the highest rate right now, and whatever your state highest rate is. But there's this little rule, or the net unrealized appreciation, sorry, it's a tongue twister, net unrealized appreciation, that you can look at the portion that's in your 401k, that's your company's stock, and you can make a choice to take that money out, just the company's stock, and roll it over into a taxable account. Of course, you're going to have to pay the tax on it. But you bought it at a lower price, and it's been sitting and growing tax deferred in your 401k all these years. So you look at, okay, what did I actually buy it for? And that gets taxed, that portion gets taxed as ordinary income. And whatever the appreciation on it that's also been sitting, growing, tax deferred, you get capital gain treatment on that portion. So it's a huge tax advantage. It's extremely complicated. So like they said, please call us.
Yeah, but so what you're saying is instead of paying ordinary taxes, ordinary income
You
tax.
can pay the lower capital gains rates on the appreciated portion.
Right.
Which is what people always say. They're, well, don't get a capital gains rates on this. But I was like, no, it's in your 401k. I didn't realize that there's this little rule that they've tucked away in the code. So
See, and this is the reason that the do-it-yourselfers don't do as well, because they don't get these ideas.
that's right.
You know, I've talked to some people that, I love doing this myself, and I'm thinking all the things that you're missing, you know, from that to structured notes to private investments to who knows what, you know, just millions of things.
This is saving the client over $10,000.
And all of that money that they take out, they
Go
can
buy
put
some
in
grapes.
great growth stock.
Exactly. It's a win-win.
Because I
Vince.
guarantee
You better not guarantee
guarantee
anything.
anything.
No, we're not guaranteeing.
No, what
anything.
I'm going to guarantee here is that
because our compliance department will have heart attacks.
the only thing I can guarantee is probably that client who had a lot of money, and that's
They're very happy.
They're very happy, and it was
Yes.
probably a technology company that they were employed with.
Maybe, but it doesn't have to be technology. I know people who've been in companies for a long time that aren't tech companies.
I know.
But their stock is
I'm
appreciated quite a bit. But it's a great strategy. I'd love to talk to you about it. Give us a call.
Yeah, there's a lot of things that we're seeing these days. We met with somebody the other day that talked about a portfolio that, you know, they do is more for tax efficient, really tax efficient. That's another thing too that we're going to maybe have a podcast on at a later date. I don't know. Again, depends on those people having heart attacks in the background in our compliance department.
But here's another thing. You have to call your advisor before you do this.
Yeah.
Please.
Not after.
Not
They
after.
say,
You can't take.
Can you fix
right.
this, or can you save me taxes?
Exactly. You can't roll it over and then say, "Oh, can we do that?" No. Call us
And
beforehand.
how many times do we have people who did something and
So
then told
many.
us about it?
Yeah, I
You know, and it cost them a lot of money. And, you know, we had an annuity issue with somebody, and
And they already took the money out, and it's like, we can't change it. You just
right,
already did
and that
it.
Or
cost them what,
sold a home,
$40,000
or-
in taxes or something.
Yeah.
I don't know. It was a lot.
It's a lot.
So so give us a call. I mean, that's why we're here. We love doing the podcast, but you know, truthfully, we like doing the.
We like sitting with clients at
Right.
the table and
And
saying,
I've had a lot of clients reach out. I mean, they're emailing, calling that because they listen too. So which is
like it.
great.
It's great. Well, it's nice to know that they're listening.
Yes, we're happy to hear. So thank you for listening to us. So over the next couple of weeks, as we're kind of ending the end of June, next week on July 3rd is Thursday, and the markets are closing early, and then July 4th we're closed. So next week we're going to go ahead and do a special podcast and get that out to you for next week. And then after that, I'm actually on vacation, so we'll be back to the updates in a couple weeks, but we'll definitely get some information out to you.
Who said that you can have a vacation?
I know, no vacation. So-
Vacation is important.
Before we end this, I got to know what the greed index,
Fear
fear and greed
and
index.
Yeah, fear and
is.
greed
Just
index.
so happen to have that. And really, there's been very little change. It's at 63,
Okay.
which is firmly within the greed area. There's extreme greed, then there's neutral, and then there's worse. So it's still, you know, really not much has changed
know.
over the last few weeks, which is surprising considering all the
the
stuff
headlines
that's
and
going on.
what's going on in the world, and yeah, it's kind of interesting. I'm a little surprised, but
Or I do believe that the market is still a little bit, you know, overvalued, if you will. The market. Now, that doesn't mean individual stocks, but the market is up to about 22 times earnings, which is unusual. One of the things that, you know, you and I talked about this, Catherine, is that I almost think that we'll have higher PE ratios permanently, maybe not at 22, because there used to be somewhere like 7,500 stocks on the marketplace. Okay, today there's about half that number. I don't know where it is, somewhere around 3,700 stocks. Yet there's more money chasing those stocks. So if you're
Supply and
buying, you're
demand.
probably buying at a higher price. It's still supply and demand. So I'm not surprised that we have higher PEs. But is 22, on the top here? Probably. But it may not go down to 10 unless you have a recession. And right now, there's no recession in sight.
I agree with that.
We could get one, but right now there's not. And, I think that's one of the reasons, going back to what we talked about before, that Powell hasn't done anything with interest rates because he probably doesn't see a recession either. So whether it goes up or down, we'll have to wait and see whether he's still there,
I feel like it's mostly been the tariffs. I think that's one of the things. Is everyone's still trying to figure out where.
Well,
we at with
it's
that.
hard for me to believe that tariffs don't cause inflation.
Yeah.
Somewhere along the line, you have to make up for that money.
2 Fed governors came out and said they didn't think it was going to cause an increase in inflation, which was kind of surprising. But hey, who am I to criticize or the Fed governor? Right?
People said we'd never make it to the moon either. So
Hey, speaking of outer space, my Martian friend is gone. He went back home.
Oh.
He's running an intergalactic long short fund now.
Okay, I have no idea what you're talking about.
that note.
But on that note, have a great week, everybody, and we'll actually see you early in the week next week
Next
with a
week,
special
early,
edition.
yes.
Take care, and thanks for listening.
Thank you.
Thank you.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.